Welcome back to the channel. Today, we're talking about something every Australian property investor and landlord needs to know. From the 1st of July, 2025, the Australian Taxation Office, or ATO, will be rolling out new reporting rules for rental income. These changes are designed to tighten compliance, reduce tax mistakes, and ensure that every dollar of rental income is reported correctly. If you own an investment property, whether it's residential, commercial, or even short-term rentals like Airbnb, these rules will affect you. In this video, we'll break down what's changing from July 2025, how the ATO's updated income matching tools work, what information third parties will now be required to report directly to the ATO, the common mistakes landlords make, and how this data matching will expose them. And finally, what you can do to prepare and protect yourself so you're not caught out. Stick around, because by the end of this video, you'll know exactly how to stay compliant under the new rental reporting regime. Let's start with the big picture. For years, the ATO has been concerned about underreporting of rental income. In fact, reviews in recent years have shown that a large percentage of property investors either fail to declare all their rental income or overclaim deductions. This doesn't always happen because people are deliberately cheating the system. Sometimes it's just poor record keeping, confusion about what counts as income, or simply forgetting to include small amounts. But from the ATO's perspective, it's a multi-billion-dollar tax gap. So, to close that gap, the government announced that starting in the 2025 to 2026 financial year, property managers, real estate agents, and even digital platforms will be required to report rental income data directly to the ATO. That means the ATO will no longer rely only on landlords to self-report. They'll be able to cross-check rental income data automatically, just like they already do with wages through single-touch payroll, or with interest and dividends reported by banks and financial institutions. This is all part of the ATO's broader data matching expansion. So, what's actually new from 1st July 2025? Here's the key change. Rental income reporting will become automated through third parties. This means 1. Property managers and real estate agents will have to submit rental payment information for every property they manage. 2. Online rental platforms such as Airbnb, Stays, and other digital accommodation providers will need to send through data about short-term rental bookings, including gross income, service fees, and even occupancy dates. 3. In some cases, even property management software providers will transmit data directly to the ATO. The ATO has stated that this will bring rental income reporting in line with other systems that already work well, such as banks reporting interest or employers reporting wages. What does this mean for you as a landlord? It means that from financial year 2025 to 2026 onwards, the ATO will know exactly how much rent you've earned, even before you lodge your tax return. Let's dive into the ATO's updated tools, because this is where the real power lies. The ATO has been refining its income matching algorithms for years. They currently use it for wages and salaries through single-touch payroll, bank interest and dividends, capital gains reporting from brokers, and now they're expanding it to include rental income. Third-party providers send raw data about rental payments to the ATO. The ATO matches this against the property owner's details, using names, addresses, ABNs, and tax file numbers. When you lodge your tax return, your reported rental income will be compared against the ATO's data. If there's a mismatch, say you reported $18,000 in rental income, but your agent's data shows $21,000, that discrepancy will trigger a red flag. In many cases, the ATO will automatically adjust your tax return, or they may send you a letter asking you to explain the difference. This is very similar to how they already send "please explain" letters when your reported income doesn't match your bank or employer records. Here are some most common mistakes landlords make, and how will these new rules catch them? 1. Many people rent out their property on Airbnb for a few weeks a year and forget to include it. Under the new system, that data will be sent straight to the ATO. 2. If a tenant's bond is withheld and passed to the landlord, that's taxable income. Many landlords forget to include it. 3. If you've been collecting cash payments and not reporting them, property managers' data will expose the mismatch. 4. Don't claim deductions for periods when the property wasn't available for rent. if you use the property yourself for part of the year, the ATO will be able to cross-check occupancy data against deductions. 5. Misreporting expenses. Even though these new rules are about income, they indirectly help the ATO spot incorrect deductions. For example, if a landlord claims expenses for a period when there's no income reported, that looks suspicious. These mismatches won't just trigger audits. In some cases, they can lead to penalties and interest charges. So, what does this mean for you as a property investor in practice? It means the margin for error is shrinking. The biggest shift here is that landlords need to move from a reactive approach, fixing mistakes after the fact, to a proactive approach of keeping records that line up with what third parties are reporting. So, how to prepare and stay compliant? You can prepare for these changes and avoid getting caught out. 1. Use professional property managers where possible. They'll now be required to report rental income, which reduces the chance of mistakes. 2. Keep your own records updated. Even though the ATO will receive data from third parties, it's still your responsibility to make sure your tax return is correct. Keep bank statements, lease agreements, and expense records. 3. Declare all sources of rental income. This includes Airbnb, short-term stays, and even informal arrangements. 4. Be accurate with deductions. Make sure you only claim expenses for the portion of the property used to earn income. If you stay in your holiday home for 2 weeks, you can't claim deductions for that period. 5. Consider using digital tools. Software that tracks income and expenses can help ensure your records line up with what's being reported. 6. Work with a tax professional. Especially in the first year of these new rules, an accountant can help you make sure you're compliant. The ATO is steadily building a system where almost every piece of financial information is pre-filled, from wages to interest to now rental income. In the long run, this means less paperwork for landlords, since more data will be pre-filled in tax returns, but also less opportunity to make mistakes or leave things out. Essentially, the tax system is moving towards an environment where the ATO already knows your income before you lodge. For honest landlords, this can actually be a good thing. Less stress, fewer errors. But for anyone hoping to fly under the radar, those days are ending. If you own an investment property, the best approach is simple. Declare everything and keep your records clean. That way, when the ATO cross-checks your data, and they will, you'll have nothing to worry about. That wraps up for today. If you found this video helpful, make sure you subscribe to the channel for more updates on Australian tax changes, investment strategies, and practical finance tips. Thanks for watching, and I'll see you in the next video.